Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of these big companies' money secrets, and sometimes that secret is that they are not making that much money at all. So buckle up because APPlife Digital Solutions Incorporated is here with a filing that is quite a ride. Alright, so APPlife Digital Solutions Incorporated, we're looking at their S-1 filing from December 2025. And this is basically their registration statement for selling a whole lot of stock to the public, the usual song and dance. But sometimes these filings can reveal a lot more than just a stock offering. They can tell us a story about the company, its struggles, and its hopes. So this company, APPlife Digital Solutions Incorporated, they're in the business of aftermarket automotive parts. Specifically, they focus on suspension lift systems and accessories for Jeeps, trucks, and SUVs. They operate through an e-commerce platform called Sugar Auto Parts Incorporated. Now here is where it gets interesting. Back in May 2025, they did a reverse merger with Sugar Auto Parts Incorporated. This means Sugar Auto Parts became the main operating company and APPlife became the public-facing entity. It is a common way for smaller companies to go public without the whole IPO song and dance. Let's talk about the shares being offered, and this is a big number. We're talking about over 1.7 billion shares of common stock, plus more shares, underlying warrants, convertible preferred stock, and convertible debentures. It is a bit of a complex structure, but the key takeaway is they are trying to sell a massive amount of equity. Right now they have about 2 billion shares outstanding, and they are looking to offer around 1.5 billion shares. So that is a lot of new stock hitting the market, potentially significant dilution for existing shareholders. Now let's dive into the numbers for the year ending the 30th of June 2025. The company had revenue of $315,130. That sounds small, but let's put it in perspective. Their total assets were about $2.8 million, but their total liabilities were even higher at $3.6 million. This means they had a deficit in stockholders' equity of over $800,000. And in that same period, their net loss was nearly $1 million. That is a lot of red ink, especially when you consider they only brought in $315,000 in revenue. It is like trying to fill a bathtub with a leaky faucet and a bucket. Fast forward to the quarter ending the 30th of September 2025. Some things improved. Revenue jumped to $464,172, and they even reported a net income of $96,322. This is a positive sign, showing some growth and a move towards profitability. But before you get too excited, let's look at the risks APPlife is upfront about the high degree of risk associated with investing in their company. This first risk factor is a big flashing red light. Their own auditors are saying there is substantial doubt about the company's ability to continue as a going concern. This means they might not be able to pay their bills or stay in business if they don't secure more funding. They explicitly state they need more money to grow. This is not unusual for a development stage company, but it is a critical dependency. If they can't raise this money, their growth plans will suffer. They have a history of losses and expect more losses, which means investors might not see a return on their investment for a while, if ever. Another point of vulnerability is their reliance on suppliers. If a supplier has issues, it directly impacts APPlife's ability to deliver products, and that can hurt sales. The stock price has been really volatile, and they expect that to continue. This is typical for smaller companies, especially those trading on over-the-counter markets like APPlife does. On the OTSID basic market, their last reported sale price was a tiny fraction of a cent. That tells you a lot. And then there is dilution. The company has a massive number of authorized but unissued shares. This means they can issue a lot more stock down the line, which can reduce the ownership percentage of existing shareholders. Now let's talk about the CM purchase agreement. They have an agreement with CM Capital Master Fund Incorporated to purchase up to $15 million worth of their common stock. This is a lifeline for the company, providing much needed capital, but it comes with conditions. CM agrees to buy the stock at a discount to the market price, specifically 95% of the lower of the daily volume weighted average price or the lowest trading price. This is a common financing structure, but the discount means the company is selling its shares for less than they might be worth on the open market. Looking at the selling security holders table, CM Capital Master Fund Incorporated is a significant player. They are slated to potentially offer over 1.5 billion shares of common stock to the public. This is a huge chunk of the company's shares. As of the 8th of December 2025, the shares registered for resale by CM would represent a significant portion of the company's outstanding stock, so they are essentially giving CM a pathway to sell a large stake. The filing also details the expenses associated with this offering, including registration fees and legal costs totaling around $19,877. This is a relatively small expense compared to the potential capital raised, but it shows the costs involved in going this route. Let's touch on the financials again. The company's consolidated balance sheet as of the 30th of June 2025 shows total assets of $2.8 million, but with liabilities totaling $3.6 million, they have a negative stockholders' equity of over $800,000. This is not a strong financial position. Their consolidated statement of operations for the period the 6th of January 2025 to the 30th of June 2025 shows revenue of $315,130, but a net loss of $997,763. This highlights a recurring theme: the company is spending a lot more than it is earning. And again, that going concern is a major red flag. They are burning through cash and need constant infusions of capital to stay afloat. In terms of business operations, they acquired assets from AP4L ABC LLC for $35,000 plus some other items. The big item here is the goodwill acquired of $2.6 million. This suggests it is an acquired company with intangible assets that were valued highly. And then the reverse acquisition of Sugar Auto Parts Incorporated. This was a significant event for them, and how they structured the deal means that financially Sugar Auto Parts is treated as the acquirer, which is a bit of a reporting quirk. They issued a lot of shares in this transaction. They've also issued convertible debt with warrants attached. The fair value of these warrants was $802,589, which was more than the proceeds from the debt itself. This is a common scenario where the warrants are so valuable that they create a discount on the debt itself, leading to significant interest expense. Their common stock is trading on the Oxford Basic Market under the symbol OLDS, and as you can see from the trading prices, it has been trading for pennies a share, very low value right now. Looking at the management's discussion and analysis, it is clear they are focused on growth opportunities and acquisitions. They are raising capital to increase their marketing and development capabilities. Their strategy revolves around growing their e-commerce business, improving their products, and acquiring other companies that fit their vision. The results of operations show that they have significant interest expenses related to their debt, which impacts their bottom line. They reported a net loss of almost $1 million for the year, ended the 30th of June 2025, and this is a recurring theme throughout their financials. Their liquidity is a major concern. They have over $111,000 in cash, but expect expenses to keep rising. They are dependent on future debt or equity investments for survival. Well, APPlife Digital Solutions Incorporated is a company in a competitive market trying to grow rapidly. They've made some smart moves like the reverse merger and obtaining capital through agreements like the CM purchase agreement. However, they are facing significant financial challenges with a history of losses and substantial debt they are heavily reliant on external financing to survive and grow. The biggest risk is their going concern status and their need for continuous funding. If they cannot secure more capital, their ability to continue operations is in serious doubt. On the other hand, their focus on the aftermarket automotive parts niche with an e-commerce platform could be an opportunity if they can scale effectively and manage their costs. Scroll clear conclusion. My take is that this is a very high risk investment. APPlife is a development stage company with a long road ahead. They have promising products and a clear strategy, but the financial figures and the constant need for funding paint a picture of significant uncertainty. Investors should be prepared for extreme volatility and the real possibility of losing their entire investment. The company needs to demonstrate consistent revenue growth and profitability to overcome its current financial hurdles. Alright, that is our deep dive into APPlife Digital Solutions Incorporated. It is a company with ambition, but facing some serious headwinds. What are your thoughts on their strategy and their financial health? Let us know in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more corporate decoder investigations. We have a fantastic Discord community linked in the description where we break down these filings even further. Join us there and let's decode some more corporate mysteries together. Thanks for watching, and we will see you next time.